Hello and welcome to this Monetary Policy Special. The Reserve Bank and its Monetary Policy Committee have just presented a monetary policy which stands out for its optimism on growth. The Reserve Bank has raised growth forecasts actually across the board. Full year FY GDP, current FY24 GDP forecast has been up from 6.5% to 7%, highest on the street, and quarter-wise as well. Q3 has been up from 6 to 6.5%, Q4 from 5.7 to 6%. In fact, next year, Q1 of next year also up from earlier 6.6 to now 6.7%. The forecast for Q2 and Q3 next year are new, but just look at the Q2 forecast at 6.5%. Remember, it comes over a 7.6% Q2 this year. So that is clearly indicating a super bullish Reserve Bank. In fact, the numbers are not telling the whole story. Why don't you listen to the governor and the deputy governor on growth?
It would be wrong to think or assume that a change of our approach or that, any kind of loosening, etc. is round the corner. That's not on the table at the moment. There are signs that rural demand is also turning around. In the first 7 months, from April to October, 36.7% growth in capital expenditure. Secondly, private capex is also showing signs of revival, particularly in sectors like petroleum, steel, cement and chemicals.
If you just sort of put that actual number and the projections we made in the last policy together, you'll come with number close to 7 or at 7.
6.86.
6.8, so 6.9. Thank you. But if you look at October-November data, the high-frequency data which we use for our nowcasts, they are all very robust right now. So if you just take October-November data, you'll exceed 7. So at the current time, 7 is like a conservative estimate.
You got that? You got that? Dr. Patra, normally conservative central banker, 7% is conservative, he says, for this year. But on inflation forecast, nothing has been changed. The current year forecast retained at 5.4% CPI, and Q1 next year also, they told us 5.2 earlier, and they have retained it, as they said in the October policy, at 5.2%. What's new are the 4% forecast for next year's Q2. Q2 next year, they expect CPI to be 4%, Q3 at 4.75%. So now some economists are therefore expecting a rate cut in Q2 next year because, CPI is going towards 4%. Now, Reserve Bank is worried about food, but it is almost triumphant that core inflation has come down because of their monetary policy. For me, the surprise here is that the Reserve Bank is not that much worried that higher growth is not leading to higher inflation. That surprises me a bit, but we'll ask our experts. Finally, Reserve Bank has emphatically reiterated that bringing down inflation is its top priority. Let me quickly take you through the stance as well. Here, the surprise is there is no surprise of any further tightening of liquidity, that is. The stance is ditto as it was in October, that is removal of accommodation. OMO, that is open market operation of sale of bonds, also remains a weapon, the governor said, and the governor also said that it will be wrong to assume any loosening is round the corner, so as tight as it was in October. Now, besides the policy itself, monetary policy, the Reserve Bank announced some very important infrastructure steps. It is setting up a cloud facility for the financial sector, for smaller entities. It's also setting up a repository for fintechs. Now, all this looks extremely ahead of the curve on digital banking on the part of the central bank. We will discuss all this. Let me introduce my elite panel to you. Dinesh Khara, Chairman, State Bank of India, is with us. Also, Samiran Chakraborty, Chief India Economist at Citi. Mridul Saggar, Chief Economist he teaches at IIM Kozhikode, and he was formerly at the Reserve Bank Monetary Policy Committee. Also with us is B. Prasanna, who is the head of Global Markets Group at ICICI Bank. Gentlemen, thank you very much for joining me. Mr. Khara, I do have a lot of questions for you, but what is bugging me is this growth number. So Mridul, directly that to you. mean, this is a huge growth revision, 7%, and yet, I mean, normally one would think steaming growth will lead to some inflation, no change in inflation. This doesn't surprise you?
Bit of a surprise. The growth has definitely surprised on the up. If you see what happened in Q1 and Q2 of this fiscal, the numbers at 7.8, 7.6 are very high. We know there is a methodological issue regarding single deflation, which is also imparting an upward bias. But notwithstanding that, the growth is genuinely on a good pace. So monetary policy can obviously breathe easy in not prematurely easing the policy. So that leeway has really come about. And the only surprise which could occur in these calculations, to my mind, could be the Q4 of fiscal 24. So that is the number which will come on a base of a 13.1% growth last year. And if by any chance the growth falls below 5.5, that is where some rethink could occur. Otherwise, there is a case for holding rates higher for longer, allowing disinflation to work and bring it back to the target.
Okay. Okay. Well, I'm still puzzled about the growth numbers in several other ways. And let me get the chairman in on that. Mr. Khara, you know, when you look at the bank disaggregated numbers, whether it comes from the Reserve Bank or individual banks, there's hardly any, you know, lending to the corporate sector because they are not asking. So, I mean, this kind of a fiery growth forecast revised higher, is it borne out by the capex cycle as you see it from your end?
Well, as far as supporting the capex cycle is concerned, some of the corporates are also depending upon their own cash accruals for the time being. And there are some data which is available which shows that the profitability numbers of the corporates are better than that the growth of the GDP number is. So that itself is a very big statement. So that is a very clear reflection that since they have much better profitability, internal cash accruals. So normally it so happens that corporates first of all resort to the internal accruals and then only they move on to borrowing mode. So though we have got a situation where we are sanctioning the limits, but of course there's always a lag between the sanction and the availment. That's a reality. But very often we have seen that if at all corporates have their own funds available, they first utilize that. That's the kind of a situation.
Yeah, I take your point that even in the previous cycle, you know, 2002, 2003 cycle, initial phases of growth, corporates rely on internal accruals. But this is still fairly significant revision in growth. You know, we are coming over a 7.2%, we have a 7% and a 6.5% next year. And we still don't see evidence of too much of corporate demand. Does that puzzle you? And secondly, we also have risk weights now, some kind of a weight attached to unsecured lending. Together, will that lower loan growth and therefore can that have some repercussions on growth?
Actually, if you look at the risk weight issue relating to unsecured credit, I think there the effort is to ensure that the growth should be a healthy growth. And with that in mind only, these kind of risk weights have been prescribed, which are on the unsecured credit. And but yes, of course, it will, I mean, overall, the NBFCs will also have a much higher risk weight as far as the lending from the banking system is concerned. So I think it is essentially to, and I've gone on record earlier also saying that before the COVID, the risk weights for the unsecured used to be 125%. So we are actually going back to the situation when pre-COVID situation when the growth used to be normal. So we're actually going back to the normal situation. So that is the reason why this kind of a increase in RWA was warranted, and that is something which has been done.
Okay. Fair point, sir. But I would still think that I think NBFC risk weight was not 125. The other unsecured, yes, was 125.
Yeah.
So I don't know. It still worries me, you know, whether we can justify this kind of growth. Other indicators are not showing that much growth as I see it. But I think we will defer to the economist on that point. Samiran, you I think are at 6.7, but that's a good 30 basis points higher than your revised forecast that we are getting from the Reserve Bank. You're comfortable with this kind of an upward revision?
So Latha, I think it's quite obvious that the economy has shown significantly more resilience than what analysts would have predicted 6-9 months back. And this is not just about India. Globally, most of the economies have done much better than anticipated. So in some sense, the negative global growth shock that people had factored in the beginning of the year on Indian economy, that has not played out. And some forecast revision is definitely warranted. And I think Mridul was highlighting this point that it's the fourth quarter FY24 where we have maximum uncertainty because there is a significant base effect in that quarter. So to some extent, the RBI forecast revision is a mark-to-market revision. All of us mostly has increased our forecast by about 50 basis points. Since RBI was at 6.5, it is quite obvious that their number is now 7% with that 50 basis point revision. But I think the bigger picture is that what happens after FY24, if our house views are correct and US, Europe go into recession in 2024, then to what extent that starts impacting India's growth, particularly the formal sector's growth, which, by the way, is the one which is driving most of these GDP numbers now. We, as you know, that the informal sector is not captured in the first advance estimate of GDP. So as we move into FY25, if the formal sector is relatively more impacted by the global growth slowdown, then we could see some moderation in growth coming next year.
Okay. Yeah, fair point. If US can grow at 5.2%, then why should we not be revised higher to 7% and next year 6.5%? Yeah, but the whole point is whether the US will continue at that pace. Point taken. A word on how bond markets are going to move. Prasanna, you know, to me it looked like cut paste from October in terms of the policy. Do you see at all the call rate coming down towards 6.5? Anything in what the governor said indicating a softness or indicating any change at all? How will rates pan out from here on?
No, in fact, Latha, I would argue that it was not a cut paste to the extent that there was no hawkish surprise that happened in both the previous policies, whether it was ICRR or it was the talk about OMOs. So definitely from that perspective, it was something, a very uneventful policy, I would say. But in terms of how the bond markets have taken it, initially it took it kind of without much change, but later on when there was a tail in the auction subscription, yields went up a little. But beyond all that, I think the clear message that the Reserve Bank seems to be sending out is that it's too early for us to even think about a change in stance or change in any kind of a rate easing stance. And from that perspective, I do think, and then there was this admission that liquidity was tighter in the last 2 months, and that is also one of the reasons that they didn't do OMO. Having said all of that, I think going forward, liquidity is going to be tight till end of December. We are going to see a lot of government balances getting built up over the next 15-30 days. And then we would see a potential liquidity inflow into the system from government spending in the fourth quarter to the extent of even maybe 2.5 lakh crores. And if that were to happen, it's quite possible that by the end of this financial year, you would see liquidity, coming back into the system a little bit. But either which way you look at it, it looks like even beyond all of this, RBI is clearly engineered a stealth hike, if you can call it that, to bring the interbank rate to something like 680, 685. And unless they start providing funds through their repo rate, the interbank fixing is not going to come down. But they don't seem to be in a mood to do that as yet. So I would say that the fixing continues at this level for some more time. And the first level of bond bullishness or dovishness doesn't need a repo rate cut by RBI. It only needs this liquidity to RBI to change its stance to allow the interbank rates to come back to around
Come
six and a
down.
half. But that is a discussion for the future, Latha. With this kind of a growth number, I don't think they, in their mind, though they are not upping their inflation forecast explicitly, I'm sure they are aware of the kind of risks that this kind of a growth number has on core inflation. And with food inflation also going to be on the higher side over the next 2 months, I'm sure they have it in their mind, and that's one of the reasons why they are, keeping it tight.
Yeah, if I put myself in those shoes, very large shoes, I would think that I would have these fears. So we'll have to try and prod the governor more when we get time. But I think the big announcements, which did not get enough media space or banking space, expert space, is this developmental products that Reserve Bank has announced, a repository for fintechs. We didn't discuss that enough. As well, rules for web aggregators and this cloud facility for the financial sector. It looks like the Reserve Bank is way ahead of its time in ensuring digital banking and digital financial sector. Those questions to Mr. Khara and of course many others to our experts in a minute after this break. Welcome back. We've been discussing monetary policy with SBI Chairman Dinesh Khara, Samiran Chakraborty of Citi, Mridul Saggar of IIM Kozhikode and B. Prasanna of ICICI Bank. Gentlemen, thank you very much for your patience. Mr. Khara, I want to ask you about this Fintech repository. This sounds like a very good idea. You know, the last time we heard of the repository was of those large credits that Krylic, and it did wonders for the banking system. This Fintech repository, do you think it's going to marry the Fintechs and banks and NBFCs? Are we going to see a quantum leap in the use of Fintech in banking?
No, I agree, because what has happened is of late, we have seen exponential growth of Fintech and also collaboration of Fintechs with the legacy players. So what has happened is that they have got unfettered access to the consumer and the customer data. And there is a need to have some kind of a order when we engage with Fintech. So if these Fintechs voluntarily engage with this repository, this will bring in a lot of credibility of about the Fintech players and also the comfort of the legacy players on the performance standards of these Fintechs also. So I think I would say that it's an excellent step which has been taken, because today when we talk about cyber, when we talk about data privacy, it is very essential that all the players in the ecosystem are mindful about their obligations and they must live up to that. I think this is one step which will ensure that eventually all of them move in tandem and which will eventually work for the good of the whole of the financial system.
I think we should get the governor on an interview or Ravi Shankar on an interview on what plans they have on this. But the cloud facility also, Chairman, what do you think? Is this only for small guys who are not able to build up systems like you and HDFC Bank and ICICI Bank? Or can this be an entire public facility? You know, like NPCIL and UPI, are they thinking of this as a whole public infrastructure, which means you can have uniform security, cyber security? You think that's the end plan?
Well, as far as the cloud facility is concerned, I would say that there's also a greater degree of reliance on the offsite centers for storing and managing all these homogeneous amount of data, which is being used by various entities. And also at the same time, the computing is actually going up quite a lot, and which will actually generate a whole lot of data. So eventually, I think to ensure that there are economies of scale, there's something which will happen. But at the same time, there was always a challenge in terms of the data privacy, how it is going to be protected. I think with the availability of this cloud facility under the aegis of RBI, that will really work wonders, and it will ensure that all the financial entities will ensure that data protection laws are implemented in its right spirit, and they will have the benefit of the security of the data too. So I think again, it's as a regulator, it's more of a path-breaking initiative which has been taken to bring the financial sector availing the cloud, and which will eventually go a long way in terms of the digitization of the economy.
Okay, those are separate chapters, and we will discuss that with you and other bankers separately. Thank you very much, Mr. Khara, for your time. Well, on more immediate market matters, Samiran, should we expect, do you push back the rate cut expectations?
I mean, on the margin, you'd say that the way the governor has put the forecast out, there is a possibility that the rate cut is pushed back a little. The key question is that whether we are right in forecasting a slightly lower growth, and on the back of that, a slightly lower inflation as we move into the latter part of the year. So just to give you a sense of numbers here, second half 2024, we think that average inflation would be trending closer to 4%, whereas the RBI trends it somewhere around 4.4, 4.5%. So if we actually get trending around 4%, then the real policy rate at that point of time becomes almost 250 basis points, and that might open up space for a small 50 basis point of rate cut in the second half of the year. And by that time, we will have more clarity on how the monsoon has progressed. We will have clarity on whether global growth actually has gone into recession in US, Europe, etc., whether other central banks have started their rate cuts or not. So that probably is a good backdrop to think of a rate cut. But much before that, we need to see the sequencing of it, with first the weighted average call rate dropping from MSF to repo rate. Second, the change of stance from withdrawal of accommodation to neutral. Only then we can think of rate cuts.
Okay, well, actually, if you can continue that argument, Prasanna, it looks like the Reserve Bank could relax a bit because we don't have that interest rate differential fear. Last time in October, they had, 5% US yields, and therefore the interest rate differential with India not being very high. Now we have a differential. So do you think that we can start talking in terms of a neutral sometime round the corner, or do you think it's best not to go down that route?
No, I think the governor in the post-policy conference, I think, put paid to any hopes of a turnaround being a change in stance being just around the corner. I think he was very categorical in his statement. And I think the way they would possibly be looking at it is, for example, the fall in bond yields from 5 to 4.25. I think that's what you're referring to as the expansion, the spread. I mean, that needs to sustain. And the kind of rate cuts that are being factored into the US markets at this point of time, which is 130 to 140 basis points, my personal view is that it's not going to happen. And so it's also a question of the market again going ahead of what they think the Fed will do. So I think these kind of concerns will still be there with the governor and the Reserve Bank team. And so they will possibly do it slowly. And also to Samiran's point about inflation coming down to around 4% and real rates, we already had a view that RBI will be cutting rates only in Q3 of next financial year, or rather the start of Q3 in the October policy. So which is when they would have the 4% inflation data behind them, and they could afford to, talk about this 25 to 50 basis point of rate cut in this cycle. But like I said, I think the liquidity is going to be the first mover of bond deals, and then only we will talk about rate cuts.
Okay. Yeah, I know. Actually, this question becomes a bit too hypothetical, too much too soon. A very quick question. I'm being warned. I'm seriously out of time. But Mridul, I have to ask you. 5.9 fiscal deficit plus 3% states. This is 9% fiscal deficit. Is seriously an economy on steroids. We have to bring it down, and my sense is that next year, in all fairness, we should bring it down to 5% or closer to that point. A 7% economy cannot get a fiscal deficit higher than that. And last time, from 2010 to 11, when we brought down the fiscal deficit by nearly 1 percentage point, growth fell by 3 percentage points. So, next year, if we really bring fiscal deficit down as we should, won't growth be affected?
Yeah, so Latha, yes, it can. The moment government seriously pushes fiscal consolidation, some growth sacrifice has to be there. As I told you today, I am at Hong Kong and was attending a seminar where actually the BIS people were very, very sort of aggressive on this front and saying that basically the fiscal positions in Asia are so much out of alignment that there's no option but to sacrifice some growth and bring about fiscal consolidation. And I'm totally in agreement with that view because we need to create fiscal space in good point of time. But on the rate hikes, let me just add a caveat here because, see, I did mention last time that I see rate hike coming somewhat in Q2 of the fiscal next year, but the growth has been much sharper, and that has sort of pushed that aside. And there is a possibility that, and most people here in Asia are seeing India and Japan being two countries which might hike rates next year instead of lowering. Okay. And Japan might obviously dump the YCC and get out of the negative interest rate policies. Okay. And for India, it depends on how inflation and growth might shape.
Okay. Okay, that means all possibilities are open. It's best not to talk so much in the future since there are so many, guesses to be made and so many things to unfold. Thank you very much, gentlemen, for parsing the current policy. The current policy is that it is as Goldilocks as it gets. We have got a huge growth number that the Reserve Bank has given us, and it is fairly restrained on inflation. So let's enjoy when the going is good. We wrap up on this special broadcast. Thank you very much for watching.